My name is Anthony Siccaro. I'm founder and president of Providence Financial and Insurance Services. The reason I became an income specialist is because most advisors specialize in growth. My definition of a successful retirement is as much income as you need until the day you die.
Meet your financial advisor, Anthony Siccaro.
With years of financial experience, Anthony helps build sustainable income while protecting your assets, guiding you to financial security.
Anthony is also an attorney, helping thousands of families with estate planning, as well as a published Amazon best-selling author.
He also hosts the Providence Financial Retirement Show
that airs Saturdays from 6 to 7 a.m. and Sundays from 7 to 8 a.m. on KNX 1070 News Radio.
You're going to learn today why the 4% rule, why taxes in retirement, the idea that you can adjust later, and the belief that the markets always come back deserve a closer look.
Anthony is also regularly featured on major news networks to provide his insights.
We know that inflation has ticked up recently over time, which is not good for the Feds, and it's put the Feds in a position to where they don't really know what to do.
What the PPI showed us, though, is that the wholesale costs are rising, and I think there's probably two reasons for this. Probably one, because of tariffs. That's starting to get passed through, but the second is because of labor inflation.
If you're still heading towards retirement, you're still 20 years away from retirement, I don't think you make a lot of change. I think you can even go more tech heavy, and I think in 20 years you'd be glad that you did that.
We're trying to educate you and help you learn what you need to know so that you can have the confidence and clarity in retirement that you deserve. Most retirees are concerned about something. Some have questions about Social Security. When do I take it? Some have questions about the taxation. We got all their money in IRAs or 401ks. And through education at Providence Financial, we help them answer those questions and give them a plan so that they don't have to wonder whether or not they're going to be okay in retirement. At Providence Financial, we'll help you develop an income strategy so that you know you have a secure future.
Providence Financial and Insurance Services, where your money meets purpose.
Well, hello, and welcome to this week's Friends and Family webinar that in the next 45 minutes or an hour or so, we're going to answer your questions. And it's actually not this week's, it's actually this quarterly Friends and Family webinar. We have a lot of you on here. Some of you are clients. Some of you are undoubtedly friends and family of clients. So welcome. Today is the day, once a quarter, where we give you the opportunity to write in your questions. We get a chance to answer them from our perspective and let you know kind of where things are going. So I'm going to start with a quick market update, just give you guys a quick idea as to what we're thinking on our end. And then we've got a lot of questions. You guys wrote in a lot. I think we have probably close to 20, if not 20. We've got questions about gold and silver, Bitcoin. We've got questions about Social Security solvency, question about inflation, a question about the 4% rule, question about variable annuities, 5-year rule for Roth conversions, question about REITs and preferreds and BDCs going down in value, and even having a question about an inherited IRA. So we're going to answer those questions. And when I'm done, I'm going to invite all of you as clients to a Dodger game. So you want to stick around for that if you haven't received an invitation before. So let's do a quick update. Just what is the market looking at? Where are we at with the market? What concerns are there? Really, it's all eyes on inflation. That's what the market is focused on. And I'm amazed that the market hasn't had a major correction at this point based on everything that's going on. The market seems to be fluffing off almost all the news that it's been given. There's not a lot of good news. You saw what happened with the war in Iran, right? I think they did something to us and we did something back to them, and the market went down. I think when I saw it, it was down at like 450 points a day, and then it came back up 100 points. I mean, just a wild, wild day in the market. And even with inflation, the inflation numbers aren't good at this point, and the market seems to be shrugging it off. Just to give you an example, the Fed's target inflation for the PCE is 2%. And right now, the PCE and the CPI are sitting at 3.8%, almost double. The PCE and CPI were 1% lower just a few months back. They've gone up. And then, and that's retail inflation. So I don't need to throw the acronyms at you, but it's retail inflation, like how much you're actually paying, 3.8%. That includes energy, though. A lot of that's because of the oil price, right? Oil price, per barrel in the 90s. That includes that. When you go X energy, meaning you take energy out of it, that's core inflation. That's going to be closer to 3%. I think it was at 3.2. Don't quote me on that, but it's certainly lower, both on the PCE and the CPI. Two different ways of measuring inflation without getting in the weeds. But there's something concerning. There's something called the PPI. It's a producer's price index. A producer's price index is the wholesale increase in prices. That's a leading indicator. What does that mean? It means that when whatever happens to the PPI kind of tells you what's going to happen to the PCE and the CPI later, because the PCE and CPI is inflation after the fact. The PPI is inflation before the fact. It tells us kind of what's going to happen with inflation. And the PPI number jumped to 6% last month for the month of April. In 2 days, it comes out again. I wouldn't be surprised if it's high again. That means that all indications that inflation is going to continue to grow up, or to go up, not grow up, I guess, but to go up. And of course, that can be problematic. Now, that puts the Federal Reserve in kind of a bind. The Federal Reserve, they have two mandates. The first mandate is to make sure that that inflation stays under control, and the second mandate is to make sure that the labor market stays in good shape as well too. That the labor rate, that the unemployment rate doesn't get out of whack. Two mandates. That's it. The unemployment rate and the inflation. Yesterday, I did a live interview, and that the conversation was these two. And these two things are pulling against each other as far as the Federal Reserve, meaning that the labor market is cooling. When I was reporting a couple years ago, there were 2 jobs available for every, no, let me back that up. Sorry. There were 2 jobs available for every worker. Want to make sure I get my 2 in 1 right. 2 jobs available for every worker. A lot of jobs, not enough people to fill those jobs. That was a result. A lot of it was because of COVID. People retired early and a lot of other things that happened there. So 2 jobs available for every worker. So what that means is that an employee could leave a company. They could go work for another company and usually get a raise in the process. Or if you did like what I did, you wanted to keep the good employees, you had to give them raises, knowing that they could go somewhere else. And so the fact is that there were 2 jobs available for workers. That means the labor market was really hot, and that's the way that it was a couple of years ago. Now that number is 1-to-1. It's a 1-to-1 ratio. It's much more equal. 1 job for every worker now that's available. It's much more normalized. And I've heard a lot of economists talk about or describe this environment as low hire, low fire. The companies that have workers are not firing anybody right now, but they're not hiring anybody right now either. So if you have a job, you don't want to leave that job. You want to kind of stay put unless you have another job first. The unemployment rate in all of that is 4.3%. It's very manageable. There's nothing wrong with the 4.3%. It's well within acceptable guidelines. So the Federal Reserve doesn't have any concerns about the labor, except over the years, last couple of years, the labor market has softened. Now, if the labor market continues softening and that unemployment rate starts to go up because tech companies are laying off people because of the AI craze, Amazon laid off some people so that they could take that money and put it into AI. Well, if the unemployment rate rises, then the Federal Reserve is going to be in a position to where they're going to want to lower rates to spur on companies to be able to hire more people to combat rising unemployment. So in one direction, the labor market could be pulling them in that direction. It's not yet, but it could go that way. Right now, they got to stay put as far as the labor is concerned. The bigger problem for the Fed is this inflation. Inflation is the big problem for the Fed because of what we just talked about. It's starting to grow. And that means that if inflation starts to get out of control, and it looks like it might be heading that way, the reality is they're going to not only not be able to lower rates, but they're going to have to raise rates. Coming into this year, they were targeted to lower. I think it was 2 times. It might have been 3, but I think it was 2 times. Right now, the next 2 meetings that they have, next meeting, which is next week, the Fed meeting, and then 6 weeks later, they do another one. Those, there's virtually no chance of them cutting or raising at this point. And then there's still a percentage odds, small odds, I think it's like 35 or 40%, that they're going to cut rates later. I don't see how they can do that. If the unemployment stays the way that it is, comfortable, and inflation keeps growing, they cannot. There's no way they can possibly cut rates. But then you throw in the mix that Jerome Powell, who was the Fed head, essentially is now gone, right? And Kevin Warsh took over. Trump put Kevin in, right? Congress put Kevin in. And he's very dovish, meaning he wants to cut rates. That's why Trump wanted him there. He's going to have a really difficult time trying to get everybody else to cut rates. You got to remember, there are 12 Federal Reserve. He's the Fed head, and he's not going to get people to cut rates. So what does that all mean? Where does that trickle down to you? What's that trickle down to the stock market? Well, the stock market wants lower interest rates. The stock market is at record highs because it's been expecting rates to be lowered. And when you look at the fact that rates are probably not going to be lowered anytime soon, and then you look at the fact that inflation goes up, which is not good for the stock market, you look at the 10-year treasury sitting at 4.53 is what it was last. That's competition to the stock market. And then you look at the war going on, and you look at just some things that happened today, right, with the strike and the retaliation and some of the things. It boggles my mind that the stock market hasn't reacted. The stock market is almost like nothing is going on. That to me is concerning. When I did my live TV interview yesterday, I used the word I hadn't used in probably 10 or 12 years. And that word is bubble. I'm feeling like there might be a bubble. Maybe it's an AI-driven bubble. Some of you are starting to feel it. When you start to get to a point where the stuff, the economics, the inflation, the wars, when that doesn't matter, when you're starting to get there, you kind of feel like maybe you're in a bubble, and the market can drop fast and it can drop a lot. There's a saying in the industry that the market takes the elevator down and the stairs up. And if you're a client of Providence Financial, that's what we're protecting you against. I know you guys. If you guys lost half your portfolio in the next year or two because the market crashed and the market finally caught up to reality, then many of you would be devastated. That's what we're protecting you from. So I'm concerned. I'm not concerned about tomorrow. I'm not concerned about the next month and maybe even for the next few months. But we don't know. There are so many things that could change, but something could happen. And all of a sudden things could turn. And what happens is you get stuck. If the market goes down 10%, you get maybe a little nervous, but we've seen this a lot of times. And then the market goes down, while you're trying to figure it out, market goes down 20%. And you're like, oh my gosh, I don't know. What do I do? And then it happens fast and the market's down 30%. And once it's down 30%, you're stuck. You can't go anywhere. And if you wanted to retire and you wanted to have 100%, but now you only have 70%, you might not be able to retire. If you wanted to get a certain amount of income off your portfolio because you wanted to travel and you just retired and now you only have 70% of what you thought you were going to have because things happen that fast, now you might not be able to do that fun stuff. That's what we're protecting retirees against. That's what we're protecting you against. So if you're a friend and if you're a family member, you're a client of Providence Financial, thank you for your trust. That's why we're protecting you. If you're a friend and someone who is hearing me or watching for the first time, I'm going to give you the chance a little bit later to schedule a 30-minute call with one of our advisors to talk about how you can protect yourself from a potential crash, which could be coming. We don't know. I'm not saying it is. I'm just saying that it could be. And if you can't afford to watch your portfolio drop by a substantial amount, 40, 50, 60%, like it has twice in the last 25 years, then you're probably invested too aggressively. That's a quick market update. It's been 15 minutes. I'm going to jump into some of the questions that we have. And we're just going to spend the rest of our time answering these questions. We'll be as long as we need. There's some really, really good questions in here, questions that a lot of you have. A couple of caveats. I don't know. These are all real questions from you. I don't know who wrote in the questions. I had one of my team members that put them all together for me and put them there. So I just have the questions and they didn't give me the names. I have no idea who wrote these questions. I also know that we got a lot of questions that were similar. So there are a few of these that actually kind of combine the question. So if you hear your question, but it's not exactly the way you wrote it, then that just means I tweaked it a little bit as well too. So let's jump in. I'll read it as I have it. What is your opinion on investing in gold, silver, and cryptocurrencies? Are any of these more or less secure or appropriate for a retirement plan compared to investing in traditional types of stocks, annuities, bonds, mutual funds, etc.? Would your firm be able to assist clients with these type of investments? So the last question is very easy to answer. The answer is yes. If you want some gold or silver, we certainly could. Even crypto, we could. There's crypto ETFs out there we can help you with. We have very few clients that are in that space, but if you want some, we certainly could. So let's talk about gold, silver, kind of put it in the precious metals category, and then crypto we'll just spend a few minutes talking about in a minute separately. Let's talk about gold and precious metals, okay? I'm not a big fan of gold, silver, and precious metals for a couple of reasons. Number one, the biggest reason is it doesn't keep pace. It barely keeps pace with inflation. That's not what you hear. It's funny. I have people all the time tell me, oh, I should be buying gold. Everyone's saying that I should be buying gold. I'm hearing about it all over the TV. I should be buying gold. It's the one thing that's been around for 3,000 years. And it's funny. I hear this story. And the one question I ask is, where do you hear about that from? Oh, I hear it on TV. Yep. Where do you hear it? It all boils down to ads. The funny thing is they flood the marketplace with ads trying to sell you gold. So it's all these ads that are informing your opinion. And it's really funny. When you look at the history of gold over the long run, going back the last century or so, gold has averaged about 4% a year. Stocks have averaged 2.5 times that amount. Stocks are a much better inflation hedge. And on top of that, gold doesn't pay you income. Now, what's interesting about gold is it will go up, and it will go up fast, and it'll go up furious, and a lot of people will buy it, and then it will drop by 30 or 40% and sit there for 20 years. And you're stuck because you got caught in that FOMO, that fraud. That's what's happened. And same thing with silver. Let me give you some numbers. I've done podcasts on gold and silver, so I'm going to answer this question in just a few minutes. But if you go to my podcast site, ProvidenceFinancialPodcast.com, or you search for the Providence Financial Retirement Show on your favorite podcast player, we have I think we're coming up on 450 episodes, everything for you to give you the education you need for retirement. The reality is that you can go in and type a keyword, type in gold and Bitcoin, and you'll find podcasts I've done on those. You get in a lot more detail. I'd recommend go listen to those. But let me give you some numbers. I wanted to write them down so I wasn't making stuff up in front of all of you. If we go back to 1980, gold in 1980 hit a peak of $850 an ounce. Okay. That was January of 1980. And then by 1999, and by the way, it dropped pretty quickly. By 1999, gold was down to $252.99. So we're talking about 19 years later. It didn't get back to even until 2007, 27 years. If you bought gold in January of 1980, you paid $850 an ounce for it, and you didn't get your $850 back till 2007. Not a great inflation hedge in my books. Then it climbed. It climbed from 2007 to 2011. Gold went straight up, and there were some people wanted to get on the boat. 2011, it peaked in September at $1,920. Okay, 1920 in September. And by December of 2015, 4 years later, it was down to $1,050. It's like a 45% drop without me pulling out a calculator. 45% drop over 4 years. And it did not get back to 1920 until 2020. So it went from 2011 to 2020, 45% drop, stayed there, or maybe grew back a little bit for 9 years. 9 years. Current price is $4,320. Gold went up something like 65% last year. And what a lot of you are thinking is oh my gosh, I missed it. I should get it. No, you got the missed it part right, but you shouldn't get it. We don't know what's going to happen, but if it follows the same, I wouldn't be surprised to see gold go from $4,320. That's what it was when I did my notes yesterday. I wouldn't be surprised to see it get cut in half. That's what's happened before. And silver's worse. I'm not going to throw the number. I'll throw one number at you. From 1980, silver peaked at $50 in 1980. The current price of silver today is $70. So we're talking about a $20 increase from 1980 to now. And what is that, like 40 some years, right? 46 years. So that's not big. But from 1980, if you bought it at $50 in January of 1980, kind of follows gold, by the way. By the early 90s, the price of gold was between $4 and $5. 95% drop. I'm sorry, not gold, silver. The price of silver was between $4 and $5. Just about 95% drop. So, and it took until 2011 to get back. So again, from 1980 to 2011, it was underwater the whole time. So I'm not a big fan of gold and silver. If you think you like it, just pay attention to who's putting all that out there. Not something that I would recommend at this point. Bitcoin. Let's switch gears and talk about Bitcoin. Should we get Bitcoin? Well, so that's a little harder to answer. Whereas right now, gold and silver are very high. And I would say, no, don't get any gold and silver. If you want to get gold and silver, wait till it gets cut in half again. Then maybe time to get by it, but not now. On the other hand, if you want some Bitcoin, I don't think there's going to be a much better time to get Bitcoin than right now. Bitcoin is between $60,000 and $65,000. It was at $65,000, I think, yesterday, or $60,000. It's somewhere in that range, and it moves like second by second. Somewhere between $60,000 and $65,000. If you go back to October of last year, it was at $126,000 was high. So it's been cut in half. And the reality is that I don't think it's going to get much lower. Now, I've been on Bitcoin TV. I've been on a couple of TVs talking about Bitcoin, and it bugs me. They call it an inflation hedge, like liquid gold. It's not. It's not an inflation hedge. It's not liquid gold. It's a gamble, really. It's not currency. There's nothing backing it. At least gold has some uses. Silver is used in, a lot of electronics and stuff like that. Bitcoin, there's nothing there. Now, in the spirit of fairness, I own some Bitcoin. I think having some in the long run is going to be good. I think it could turn into a currency in the next couple of decades. That's not 5 years down the road. It's not 10 years down the road. There's a limited number of Bitcoin. There's 21 million Bitcoin, and only something like 20 million have been mined. So there's some more to be mined. But the reality is it can't go anywhere because governments have swapped over to Bitcoin, some third world countries. There's ETFs surrounding Bitcoin. If Bitcoin went away, our entire economy, our world economy would collapse. Bitcoin is ingrained. It's not going anywhere. So having some of it makes sense. And there's a lot of people, and I believe this, there's a lot of people that think it's going to go to $1 million a coin. And right now it's $60,000 a coin, whereas it was $126,000 a coin before. Now, it's been cut in half. It's been cut in half before. I remember, I don't want to make up dates, but it was several years ago that it was at $70,000, and then it went back down to $30,000. Big drop. Actually, I think it got down to $25,000, like a 70% drop. And then within a couple of years, it came back to 70. And then it climbed up to 126, and now it's down at 60. I don't see it going too much further down. Could it? Of course it could. I'm not controlling it. No one controls it. It could go down. But the reality is that I think there's a chance that it goes up and continues to grow beyond that 126,000 and march over the next decade or so towards that $1 million. And it tends to grow really quick. So if you want some Bitcoin, it treat it as an asset class. If you want to put something in there, 1 or 2% or 5% of your portfolio, depending on your situation, put it there. Realize it's a gamble. Forget about it. It's just pretend that it doesn't even exist. It's not going to provide you any income. And my guess is in 5 or 10 years at this price, you'll probably be glad you did that, but you can't bank on it. We lost a client recently because he wanted to put a lot of money in Bitcoin because he had his son that was going on. And I don't know if you're on. As a matter of fact, I have no idea who's on here because I don't have names of who's here. I can just see how many of you are there. But literally, he wanted to put some money in Bitcoin, and his son kept saying, try and do it. And I was like, I know your situation. You don't put. He wanted to put way too much, and I wasn't going to bend. I'm like, you want to put your retirement in jeopardy? Do it on your dime. Don't do it on my dime. And as a result, he wound up leaving, and that's fine because by the way, I think Bitcoin was 30 or 40,000 higher than it is now. So not a good thing. Use it as an asset class. If you want to put something in it, just make sure be responsible. Make sure you don't put too much. It's something that could go backwards. It's something that don't bet your entire retirement. Whatever you want on there, I don't want whatever you put there to affect your future retirement. So hopefully that helps with regards to gold, silver, Bitcoin. Let's see what other questions we have. Let's move on. So we had a question. It came in as this: do you have information on TFRAs, which are tax-free retirement accounts, and also gold IRAs? So that's apropos. So a tax-free retirement account is a marketing ploy. So you've heard from a marketer that basically is trying to sell you a tax-free retirement account. And there's several ways that can be positioned. And the question didn't really articulate which way you're talking about. But the most common TFRA, tax-free retirement account, is a life insurance policy that will provide you tax-free income. So that's what I'm guessing is what you meant by that question. And the answer is, if you're younger, using some type of life insurance, what's called permanent life insurance, to build up tax-free cash could make a lot of sense. I started a life insurance policy for each of my kids when they were young. I'm putting in $100 a month in each of theirs from their birth. And by the time they turn 65 years old at $100 a month, it'll be worth over $500,000 for them at $100 a month from the time they were born, using the power of compounding. So it's not a huge amount of money. I also have one myself when I think 15 years ago, I started adding quite a bit to it every month, and I can get it out tax-free. It's not bad. There's nothing wrong with it. It's a pretty conservative investment. There's several different ways to set it up. The problem is the older you get, the less beneficial they become. It's life insurance. And when you get older, you get close to, the mortality age. Then what winds up happening is the expenses in there and the charges for the death benefit that all has to be compensated. Those charges get more expensive the older you get. And that means that the more expensive it is, the less earnings you're going to get, the less valuable it is for you. So we've run the numbers a lot. I have a few people that it makes sense for and that we've done it. But in general, if you get above 65 or 70, it's not something I would necessarily recommend. The numbers just don't make sense. If you're 50 to 65, it could make sense, just depending on your situation. But you also have to save. That's not the place where you want to save $20 a month or $100 a month. If you can save 10, 15, 20, or or $40,000 or $50,000 a year, it's one of those things too that if you can front load it for 5 or 10 years with $25,000, $50,000, then it could make sense. But I'm not a huge fan because of the charges as you get a little bit older. But in the right situation, they could work. So then your next question was, what was your next question? It was about, gold IRAs. That's easy. You can set up, so it depends on what we talk about gold IRAs. If you buy gold through an ETF, the most common gold ETF is GLD. It just tracks the price of gold. You can buy that right inside your IRA. You don't need to do anything special. If you want to buy Bitcoin in an IRA, or you want to buy gold or silver, the actual metal, like the bar, you want to buy that inside an IRA, you can do it. You have to set up a self-directed IRA. And then there's a lot of rules you got to follow. But if you set up a self-directed IRA, they know the rules. You can go ahead and do it that way. And there's a lot of self-directed IRAs out there that you can Google and search one, and you can set it up that way as well too. So you can actually own physical gold in a self-directed IRA. Now you can't take possession of it, but it will be held for you by the custodian. So beautiful. So good question. Let's move on. We got a lot of questions about this. A lot of questions about Social Security. So I'm going to read the ones I have. Let me spit them all out. We'll see if we can answer them. How do you determine what is the best age to take Social Security? What is the best way to analyze whether or not to draw Social Security benefits? I believe Social Security grows at 8% a year until age 70. So if your investments are not making that return, should you draw from those instead? Great question. Very logical question. Next, will Social Security be reduced by 30% in 2034? What are the odds of this happening? And then if it's going to happen, do you take it earlier than desired, but lock in the distributions? Great, solid questions. What else? Will Social Security be dissolved? Okay, same thing. What changes, if any, can we anticipate with Social Security in light of precarious position? Okay, so same questions, all about Social Security, the solvency, so when to take it. So let's talk about the solvency first, because that's the one that you guys are all like, oh my gosh, you guys are going to be here. And Social Security has been all over the news. I suspect that's why, even today, as I had CNBC on when I was in the office, I saw a lot of just reports about Social Security. I think the one report said it's going to be, exhausted by 2032. So somewhere between 2032 and 2034, they're saying it's going to be exhausted. Now, the reports that I've read, some of them have said, everyone's going to lose their Social Security, and it's this big mayhem. That's not the case. Depending on how you look at it, and depending on what the government does, the worst case scenario is your payments get cut between 19% and 22%. That's the worst case. You're not going to lose all your Social Security. Now, I don't want to be the president when that happens. That's probably not going to be a good political situation to be in. So, but the reality is you don't really want to be the president when you make any changes with Social Security, because any changes you make with Social Security are not going to be positive. The problem is the government, do they make decisions like right now when, we got 7 years to go. So let's work on it now. Or are they probably going to make those decisions like December of 2032 when the last checks start to come? You know the answer to that? Why do they wait until the last minute? But they do. The challenge with that is there's a lot less options in 2032 than they have right now. The options don't go away. There are a lot of things that they can do to fix it. But the reality is that if they start now, they can grandfather in some of these changes. Whereas if they wait till 2032, they're going to have to make a more abrupt shift. What are some of the things they can do? Well, right now, for example, employers, employees are only paying FICA tax on the first $181,000 of income. So if you make more than $181,000, you're only paying tax on $181,000. Well, they can increase that. I heard someone say when I was listening to, actually, I don't remember where I was listening to, quite frankly, but I felt like it was reputable. But I heard someone say that if they take that number and they raise it to $250,000 a year, just the $180,000 of tax, and they start taxing the first $250,000 instead of 180, this woman had done the math and basically said it solves the entire problem. Now, I haven't done the math. Don't hold me to that, but I believe it. From what I know, I believe that probably solves a big chunk of the problem. And even if it's not $250,000, even if they have to raise it higher than that, that's one of the things they can do. Now, if they wait until 2032 to raise it, they might have to make a big jump right away. But if they start doing it now, they could raise it 5%, 10% a year for the next few years. They can solve it. That's one of the things they can do. The employer side, same thing. As an employer, we pay into Social Security as well, too. They can raise our side as well. That's another way to gradually solve it. If they start 7 years ahead of time and they do it for 7 years, then in fact, it's a lot easier than if they wait till last minute. They're probably going to wait till last minute, unfortunately. What else can they do? Something else that they could do with Social Security is they could increase the full retirement age. They've already done that, right? You might remember it was only, 30, 40 years ago? I want to say it was probably only 40 years ago, but not that long ago, where there was, one age to collect Social Security. What age was it? It was 65. That's it, right? Your parents only had one decision to make about Social Security, and that was what time to go to the mailbox to get the check. That's it. They didn't have 62. They didn't have full retirement age. They didn't have 70. That was 65 years old. That's it. And now they started playing with the system and making it. And you've heard it said, right? 70 is the new 50, right? 60 is the new 45. Whatever. It's absolutely very true. When you go back and you look at Social Security in 1935, the average life expectancy in 1935 was 67 years old. If you're supposed to get it at 65 and you died at 67, Social Security didn't have a problem. Life expectancies today is in the 80s. So the reality is no wonder there's a strain on the system. And I would be all for making and taking Social Security and making it a little longer so that people aren't collecting Social Security for longer than they were working. That's not what the system was designed for. So the reality is there's lots of ways to solve the problem. The problem is not mathematical. They can fix it from a math standpoint, different things they can do. No politician wants to tell you that your full retirement age is moving. No politician wants to tell employers that their taxes are going up, that you're going to pay more tax to employees. No one wants to do that, so they're just kicking it down. But at some point in time, that leads to the question, is it going to get cut? I would bet my entire life, okay, maybe that's extreme. I would bet, no, it's not going to get cut. I don't think you have anything to worry about. It would be a dramatic move. They can fix it. It's more of a political issue than it is a mathematical issue. I'm not worried about it getting cut. So if you're trying to decide, do I take Social Security at 62 or do I wait till 70? Because if it gets cut, I don't think that in my conversations, that's not coming into play. So I really don't think you have an issue there. Social Security, it all breaks even at 80 years old. It's all based on mortality tables. So whether you take it early at 62 or whether you take it at 70 years old, by the time you reach the age of 80, it's all going to be about the same. You're going to have gotten about the same amount at the age of 80 years old. Now, the question then is, what's the better time to take it and what do you want to be thinking about? Well, first of all, when we run a Social Security report, we run it based on lifetime income. And I will tell you that if someone lives to the age of 93 years old and you have a married couple that lives at the age of 93 years old, one of them, oftentimes the difference between claiming it at 62 years old or waiting until 70, the difference oftentimes is a couple $100,000 of income that they made or income that they lost because they took it too early. So if you're going to live to beyond the 90s or beyond, really anything beyond 80s, once you get beyond 80 years old, you're really going to be glad that you waited till 70. So if you're going to back me in a corner and basically say, hey, you need to, what's the right answer? I'm going to say most of the times waiting till 70 is what makes the most sense, but not always 100% of the time. And then there's other things that have to be taken into consideration. Your health has to be taken into consideration. If you're single and you're 62 years old, you might not make it till, another 10 or 15 years. You probably want to take it while you can. On the other hand, if you're married and you're 62 years old and you're the breadwinner and you're going to get a high Social Security, higher than your spouse, and you wait until 70, even though maybe you might not live to 80, well, now there's a widow's benefit. And that means that when you pass away, the surviving spouse is going to get your benefit, which would then be a reason to wait, even if it wasn't for health. So unfortunately, there's not a one-size-fits-all answer. It's very personable. And I don't want to take too much time here because this probably only applies to a small segment of you. What I will say is we have software in our office that will allow us to take your Social Security statements, put them into our software, and come up with a strategy that is the best for you based on your situation, strictly based on math. And you don't want to make a decision solely based on math. But the reality is that it's a good place to start, knowing what the math says, and then kind of making some decisions from there. So hopefully that helps answer some questions about Social Security. Let's go on. Next question. I'll be 80 in July. How much should I have to continue retirement comfortably? How much should I have to continue retirement comfortably? That's the wrong question. The question is not tied to how much should you have. The question is, how much income do you need? It's at what income can you retire? At what income can you stay retired? It's not about the pile. And that's a mistake that a lot of people make. It's how much that pile can give you. So the answer is this: you need to be able to retire successfully, more income than your expenses are, and be able to adjust for inflation. That's what you need. My definition for decades of a successful retirement is as much income as you need until the day you die. If you've got $250,000 and you have $20,000 a year of income, $20,000 a month of income, you might be better off than someone that's got $1 million and maybe only $5,000 a month of income. It's all about the income. I would prioritize the income over the asset, but you need as much income. You need the amount of income to be able to cover your expenses and then be able to adjust for inflation. So whatever that number looks like for you is what the number is. And don't forget about taxes. Don't forget about taxes as well. What's the next question? How to best protect from inflation in retirement? Great question. Inflation is a big question in light of the preamble that I kind of gave you, right? The fact is that when we hear inflation, and I get this question a lot from radio listeners when I talk about inflation and I talk about income on the radio show, for those of you that know, right? The reality is that when I hear inflation, there seems to be something in people's minds that if I invest in fixed income, like at Providence Financial, we focus on, if I invest for fixed income, then we're going to lose to inflation. I don't know where that comes from. But if inflation is 3.8%, as we said, and then that's temporary because of the energy prices, the more typical range, long-term range of inflation is 3, but call it 3 to 4. If inflation is 3 to 4%, but in fixed income, you're earning 5% to 6% per year of net interest and dividend income, which is what all of you are earning. That's our target. That's what we're good at. If you're earning 5 or 6%, but inflation is 3 or 4%, aren't you keeping pace with inflation? But I don't know, something out there or something in people's minds often seems that like you can't be invested in fixed income and stay pace with inflation. That's just not true. Fixed income, I think, is a great way to stay pace with inflation. If you're invested in the stock market and the stock market, drops over time or stays flat, that's not a good inflation hedge. If you look at the time period from 2000 to 2013 with the stock market, there were 2 crashes, 2 recoveries, 0 growth in the stock market for 13 years. If you look at the time period from 1966 to 1982, stock market, 4 crashes, 4 recoveries, no growth for 16 years. If you look at 1929, the Great Depression, to 1954, the market lost 90% overnight and did not recover for 25 years later. Whether it's the last 13 years, which of our current time period, which was the first 13 years of the century, or 1966 and 1982, 16 years, or that 25-year time period that right after the Great Depression, that's not a good inflation hedge. The market has long periods of time where it's flat and long periods of time where it's followed by really good times. And the first 13 years of this century was flat. The last 13 years, taking us to 2026, 13 and 13, 26. The last 13 years, the market's gone straight up. And if the market does what a lot of people are thinking it's going to do, it could have another decade or decade and a half of flat, which is not a good inflation hedge. And sometimes people will say, well, look, you've got to be on the market because it's a good inflation hedge. It's been a fantastic inflation hedge for the last 13 years. It was a horrible inflation hedge for the previous 13 years. It depends on what decade we're talking about. If you take any 30 or 40-year period of time, it's always been a good inflation hedge, 30 to 40 years. But if you're 70 years old, do you have 30 to 40 years? If you're 65 and it turns out that the next 13 years happens to be the flat 13 years of this 30 to 40 years, you're going to be 83 before you can actually start spending money again. So you got to be really careful. The stock market over the long run is a great inflation hedge. Over the short run, who knows? It's not a great inflation hedge if the market drops by 50% in the next 2 or 3 years. That's worse. That's negative inflation. So the reality is fixed income is really a solid way to stay pace with inflation. On top of that, though, you should be not spending everything that you're making. It's just like when you were in the accumulation phase of life. If you spent everything you made, you wouldn't have enough to be able to save. And it's no different in retirement. If you're making income and you're spending all the income, then the only way to start adjusting for inflation is to start dipping in the principal. And I don't care if you dip in the principal as long as you get into your 80s before you do it. I mean, even if you're 81, 82, you might still have another 2 decades to go. I have an aunt that died at 103. I was talking with a client within the last week that has an aunt or someone that's still alive at 103 years old. The reality is you might, I find that a lot of people underestimate how long they could live. So if your goal is to die with no money and you don't mind spending your principal, great, but you can't start spending your principal in your 60s or 70s. You got to wait till your early 80s to start spending your principal, and then you can wind it down and really put something together to where you're out of money in early 100s or something like that. So hopefully that answers that question about inflation. I think the 2 answers are, income is a great inflation hedge every year because you know what your income is. And then just like everything else, spend less than you make. Okay. Next question, 4% rule. When I start required minimum distributions in 2 years, I have to take almost that much. And each year it goes up. Why does the 4% rule get a bad rap? Okay, great question. I love this question. Why does it get a bad rap? But first, $4 rule. William Bingham created the 4% rule in 94. And I don't want to say he created it. I think he's an economist, but he created this rule in a high interest rate environment. You remember what interest rate was back in the 80s and 90s, right? Very high interest. And the idea is that if you have a certain percentage of your portfolio in stock funds, mutual funds, bond mutual funds, 60, 40, 70, 30, that you could withdraw 4% a year and never have to worry about running out of money. That's the idea. But the key behind this is that you're still selling principal. If you are invested for capital appreciation, whether it's stock mutual funds or bond mutual funds, focus on capital appreciation. The only way to get income from your portfolio is to cannibalize your principal. You have to sell shares this year so you can pay the bills. That means next year you have less shares of your mutual funds. The following year you have less shares. So you're cannibalizing your principal, secretly hoping and maybe wondering but hoping that whatever is left grows enough every year to offset the shares you had to sell. So if you're selling 4% a year of shares, then every year your portfolio is expected to grow by 4% a year. And if that worked that way, if you sold 4% of shares and your portfolio grew by 4% a year every single year for the rest of your life, no problem. But does the market work that way? I don't care how you're invested. If you're having to cannibalize your principal, there's going to be a lot of volatility. And what happens when the market goes down? What happens if the market goes down 10 or 15 or 20 or 30 or 40%? And you still need to make a withdrawal. Well, 4% is not 4% anymore. 4% might be 8%. So what do? Because as far as I understand, bill paying in retirement is not optional. So you still have your bills to pay, and maybe you cut back on your lifestyle. Maybe you cut back on some of the things that you can cut back on, travel or giving to the grandkids or whatever it is. But if the market drops, then you have to take out the same amount of income. It becomes a much higher percentage, and that puts you in a lot of danger. Now, the 4% rule has also been questioned a lot. I remember reading a report that was like 2015, I think, where Morningstar basically said the safe withdrawal rule was no longer 4%. That was being questioned. They basically did their analysis and said that the safe withdrawal rule was 2.8%, not 4%. And then recently they increased it to, I think, 3.1 and then the 3.3. So the fact is that they don't even know what the safe withdrawal is. It depends on what's going on in the market. It depends on the interest rates. It depends on a lot of factors, but it's disturbing to not even know what the safe withdrawal rate is. And interestingly enough, the safe withdrawal rate is defined as the percentage you can take out that gives you a 90% chance of making it to 90 years old. Which then my question is, what happens if you live past 90? And do we want a 10% chance that we might run out of money by 90? It makes no sense. So the reality is that the 4% rule has been questioned. I think rightfully so. It was developed in a very high interest rate. The latter half of the 90s was the tail end of the best bull market this country's ever seen. And William Bingham put this rule into 94. Put it in 94, or not put it in again. He's kind of the one that made it popular. And then it got steam over the next 6 or 7 years before the tech crash happened in 2001. So that's when it was implemented. And then 2001, the tech crash, and interest rates have been zero. I mean, until just recently, right? They were zero. So the question was, can the 4% rule still hold up in a zero interest rate environment? And that's when all these questions have come up. And the answer was no, it doesn't look like it. It doesn't make sense. Now, here's something interesting. I'll just throw this out there for you. Is I had a chance. William Bingham was quoted in a U.S. News and World Report magazine article 4 or 5 months ago, 6 months ago. I don't know. Time goes by so fast, but 6 months ago or so. And he was talking about why the 4% rule is no longer valid. And I got a chance to be in there with him. They took some of my commentary. They called me up and asked me for some. So I'm in there kind of commenting on some of the things that I just shared with you. So it's really good. You can actually go search it, U.S. News and World Report, search Anthony Siccaro, And you'll probably find it just something for fun for reading. So that's why I think he gets a bad rap. Oh, let me close it out though. Here's the deal. If you're getting 5% of interest and dividends, you can spend interest and dividends without ever touching your principal. So if you're spending your interest and dividends and you're not selling shares, you're not touching your principal, you're not cannibalizing your principal, how long will your portfolio last? Answer, forever. So you could get 4% a year, the rule of 4%, because you're invested for growth. It's not designed for income, and you could be selling shares at 4%, or you could get 5 or 6% a year without ever selling shares. And you go from the uncertain, the unknown, can I take out 4%? Can I take out 3%? To being able to know you can take out 5 or 6% and be able to sleep at night, never have to worry about it. That's the difference between focusing on being invested for capital appreciation and taking income by cannibalizing your principal, or taking income through interest and dividends. That's the difference. Okay, let's move on. Hopefully that helps. What else? What is RMD? Easy question. What's an RMD? How is it reported? What type of income accounts are affected? RMD stands for required minimum distribution. All the accounts that are affected, pay attention for those of you that have simple IRAs, traditional IRAs, 401ks, 403bs, TSPs, TSAs, any type of pre-tax retirement account that you've been putting money in and never paid tax on. Those are the type of accounts that are affected. And when you turn 73 or 75 years old, depending on your age now, if you were born before 1960, your RMD age is going to be 73. After 1960, your RMD age is going to be 75. So whatever your RMD age is, when you get to that year, you have to start taking withdrawals from your pre-tax retirement accounts. You have to claim those withdrawals as income. You have to put it on your income tax, and then you have to pay tax on those RMDs. So that's what RMDs are. When you take an RMD, a custodian that sends the money to you is going to issue you a 1099-R. That 1099-R basically, one goes to you, one goes to the government, that says that, hey, you took out this amount. Now you have to claim it as income. So that's what RMDs are, and that's how they are affected, and the type of income and accounts that are affected. Note, Roth IRAs are not subject to RMD. Why would they be? You've already paid the tax on them, and they are tax-free. The growth is tax-free, so the government has no benefit by forcing you to take required minimum distribution, so they don't care. Anything that you haven't paid tax on already is then going to be subject to an RMD. So let's move on. Let me see, what time is it? 7:30. Okay, we probably cost ourselves 15, 20 minutes. So you guys okay for another 15, 20 minutes? I probably wrap up. Yes. You guys want to throw some answers in there while I read this next question? Okay, I'm not seeing anything. Hopefully I didn't lose you guys. So I'm going to keep going. I'm age 83, and I manage my own retirement accounts. Okay, you guys are giving me some yeses. Okay, let's keep going. I'm age 83, and I manage my own retirement accounts. I have a large portfolio, and I'm comfortable with this approach. However, I would like to cut back on my personal involvement and enjoy life more. I'm seeking a balanced approach. Can you recommend any techniques or approaches to accomplish this challenge? Yes, there's several ways. And there's also some assumptions that I have to make, or it depends on how you would answer some questions. You're 83. You're comfortable managing your own portfolio. You don't say whether you're a client of ours or not. Sounds like you're probably not a client of ours. And you just want to cut back. And by the way, we have a lot of clients that are really sophisticated. I'm going to say probably 25% of our clients are really sophisticated. And I've often said that if you know what you're doing, you don't need a financial advisor. If you know how to change the brakes on your car, you don't need a mechanic, right? Or you know how to fix your toilet, or you don't need, but most people don't know how they're doing. And generally speaking, even people that know what they're doing are great at saving money, but they've never retired. And the strategies in retirement, when it comes to Social Security and Medicare and IRA and RMDs, like we talked about, and Roth conversions that someone asked about, and when to take Social Security, it's impossible unless you are a professional in the industry. It's impossible to know all of that. And I've been doing this 27 years, and I'm still learning. And all I do all day, every day is focus on helping people retire. And you have to know a lot. You have to be able to take all those pieces and put them in the puzzle. But if you want to take the time and education, and you're willing to take the risk, then maybe you don't need a retirement advisor. But retirement is the most expensive purchase you're ever going to make, and you get one shot. You can mess up when you're 20 and 30 and 40, but you mess up when you're 65 or 70, and it could cost you your entire retirement. So it's not something that I recommend going alone, but you certainly could. But this individual is 83 years old and has a large portfolio, just wants to cut back. We have a lot of sophisticated clients, I started to say, that want to cut back. They want to live retirement, and they want us helping them, not because they're not capable, but they want us helping them because of the fact that they don't want to worry about the money when they're taking a cruise. I remember some years ago, I had a guy that said, it seems like the market goes down every time I take a cruise and it ruins my cruise. And I kid you not, I don't remember who it was, but said that. And it's true. And if you're always watching the market and you're invested, retirement is not just about the math. It's about the psychology. If you're having to sell principal to get your income, like we talked about a little earlier, how do you feel when you know you have to sell more shares if you want to take another trip or you want to stay longer or travel better, but you got to sell more shares? You got to cannibalize your principal faster to do that. You're not going to do it. But if you have interest in dividends, you have income coming in and you know you can spend that income and it's going to come back again next year, you're very comfortable spending the income. It's almost like, like think about like a wood burning stove, right? If you're out in the cold somewhere and you have a wood burning stove, you're going to think twice before you put a log in that stove. And you might get cold sometimes and you might suck it up because it's really not that cold. And I don't want to run out of wood, right? So you got the limited wood. But what if you had solar? Now you never have to worry about running out of wood. That's a difference between living off of interest and dividends and having to sell shares. That's the difference. It's a mindset. It also frees you up to feel like you can spend your income because you know you're not chopping wood. You know that you're not selling the wood. You're not selling. You know you're not burning the wood. That's the difference. So the reality is that 83 years old. I don't know whether or not you want to continue being aggressive. I don't know your situation, but I'm going to say this: if you want to be aggressive and you don't want to have someone help you, and you don't feel like you need someone to help you, you might have enough money to where you could lose half of it and it wouldn't affect your retirement. Then great. Stick with ETFs. I would say get some ETFs. You might want to get some ETFs. You want to be a little more aggressive. You might want to get some ETFs in the AI space, the IT space, right? That's going to keep growing with the AI craze going on. You might want to get some financials. Interest rates higher for longer is good for financials. You might want to get some healthcare, some REITs, as well. Healthcare is a great staple, consumer staple. And as inflation happens, they can pass on the rates to you because you're going to get healthcare no matter what. So, if you want to stick with, you want to simplify your life, you don't want stocks, just get some ETFs and let them sit there. That's one way to do it. If you're saying, no, Anthony, I agree that, I'm a little too aggressive. I should be more conservative. You could put it in some bonds. You could put it in some annuities. There are annuities out there today that will give you 6-7% a year. I would put my money on 6-7% a year with some of the annuities that are today based on interest rates and everything. And these are ironclad for the most part. I mean, they're backed by the full faith of the insurance company, but as far as I know, no one's ever lost a dime in any type of indexed or fixed annuity out there. You could get 5% guaranteed for like 10 years, or you can get an index annuity that's probably going to pay you, 6 or 7% over the next 10 years. And if you just want to put your money aside and forget about it, not work, maybe you dump it into an annuity and take your 5 or 6% and go take your cruises and do whatever you want and simplify things. So that could be an alternative. Now, of course, the ETFs is one side. That's the aggressive. That's like this side. The annuities, the opposite side. The ETFs would be really aggressive. I would say, more passive. You don't have to do a lot of active management, but you're still subject to a 50% loss. The annuity, you're not going to get the 20 or 30% gain, but you're also not going to get the 20 or 30% loss. You'll get no loss. So, and there's some things in the middle as well too. And if you want something in the middle, I don't know, maybe you contact us and we help you get 5-6% and we manage it for you. So that's an option as well too. So hopefully that helps answer that question. Let's move on. What do you do with the variable annuity that you no longer need except for your legacy? So that's a good question. And it's funny. I get the feeling you've talked to someone, because variable annuities a lot of times are looked at by the issuers, the insurance companies, as legacy vehicles. Variable annuities are really sneaky. I don't like them. I'm not a big fan of them. And there's some variations that have come out that have gotten me to maybe start to change my mind a little bit, because they have some things that they're growing, but still not a fan of them. here's the deal with the variable annuity. When you buy a variable annuity, your fees, it's not uncommon to see 3 or 4% a year fees. 3 to 4% a year. That's a magnificent fee. I remember doing a variable annuity analysis, I think a couple of years ago, and I ran the numbers. And the person had made $150,000 in their variable annuity, but they only had $75,000 of it because the insurance company had charged them $75,000 in fees over the time they had the annuity. But they're taking all the risk. So wait a second, you're splitting the gains, but you're taking all the risk? That makes no sense to me. But that's the way variable annuities are. They're very expensive. But there's one feature that's pretty sneaky that you look at and you go, hey, that's great. I love it. And the insurance company goes, hey, that's great. I love it. Well, here's what it is. That feature is a death benefit. Most variable annuities come with a death benefit. The death benefit says that if the account value is down and you die, that your beneficiaries will get whatever you put into the account. So if the account, you put in $1 million into a variable annuity and it drops to $500,000 and you die, then your beneficiaries will get $1 million. And you're probably thinking, yeah, that's great. Yeah, well, the insurance company is thinking, yeah, that's great. And I got to tell you, if it's good for them, it's not good for you. Why is it good for them? Because they're going to be charging you that 3 to 4% every year. And what's happening now is your $1 million went down to $500,000. So you know that if you die, then your kids are going to get $1 million, or you could cash it in at $5 million. What are you going to do? You're probably, if you're like most people I've talked to in this situation, you're probably going to leave it, keep paying the fees, and wait till you die, because then you know the kids are going to get the $1 million back. Meanwhile, on $1 million, your fees are $30,000 to $40,000 a year. You pay that for 10 years, $300,000 to $400,000. I see it all the time. So the reality is it becomes a legacy vehicle, and insurance companies have a way of sucking you in that situation because you don't want to leave and they don't want you to leave either. So it's really good for them. It's not great. So the answer then is, and now, by the way, we've seen a lot of variable annuities that have gone up. If you have a variable annuity, by the way, and you didn't know this, get in touch with my office. I'm going to, at the end when I'm done, and I feel like I've gone on OT, but I also know we had some technical issues here too. So I'm going to give you the opportunity to schedule a 30-minute call on calendar for one of our advisors when we're done. So if you want to do that, but if you have a variable annuity, please have us analyze it, because there's more to it than meets the eye. We analyzed one just recently where it turns out that they were going to get some type of guaranteed lifetime income, but that only turned out to be true until the balance ran out. And then once the balance ran out, their income got slashed. They had no idea that was it. They were actually able to take that money, put it into an index annuity, get a higher guaranteed lifetime income that was guaranteed for both of their lives for their entire life. So they protected their principal, they dramatically lowered their fee, and the income was never going to get cut. So if you have a variable annuity, it's not a bad time to evaluate it. A horrible time to evaluate it's when the market's down and when you've lost your shirt. Market's at record highs. Your variable annuity's probably done well. The time to get out is not when you find out that what I've said is true, and you don't want to wait till it goes down to find out. So find out what the provisions are now, and we'll look at it. So what else? Hopefully that helps a little bit. Please explain the 5-year rule when it comes to making Roth conversions. So I'm going to have to answer these questions quickly. Otherwise, we could be another half hour. Roth conversions, there's two. Well, first of all, the question actually talks about Roth IRAs. So not so much conversions. There's 2 5-year rules. If you are contributing to a Roth IRA, the first 5-year rule says that you have to have a Roth IRA in there for 5 years in order for it to be a qualifying event or qualifying Roth IRA. The 5 years starts January 1st of the year that you make your contribution. So if you make a contribution December 31st of 2026, they credit you for the entire year. You only have to have it for 4 more years, but you have to have it for 5 years. And in order to get out the earnings tax-free, you have to have it for 5 years or until you're 59 and a half. What's nice about Roth IRAs is that you can always take out the contributions tax-free at any point in time. That also makes them a really good emergency fund. You put money into a Roth IRA, you make your contributions, you can do $7,000 a year, $7,500 a year, or $8,500 a year as catch-up. And actually, I don't know why I'm blanking on the number. I think it's $7,500 or $8,500 a year with the catch-up. But the bottom line is you can put this in. If you put in $25,000, let's say, over 5 years, you can always take that $25,000 out anytime you want. No tax, no penalty at all, no matter what age you are, no restrictions. You can always take it out. But if you don't ever need it because it's an emergency fund and you find other cash to deal with the emergency, now it's growing tax-free for the rest of your life. Once you turn 59 and a half, all your principal and whatever it's grown to is now 100% tax-free. So that's the first 5-year rule. You got to let it sit for 5 years before taking anything out other than your principal. You can always take out principal. The second 5-year rule has to do with Roth conversions. Every time you do a Roth conversion, it depends. What happens to that is there's a 5-year clock that starts unless you're over 59 and a half. If you're over 59 and a half, essentially you can do a conversion. You can take everything out tax-free the next day if you want, because you've already paid the tax on the conversion. The key and where it starts to get tricky is if you do a Roth conversion before you're 59 and a half years old. Every Roth conversion you do starts a clock, and it's a 5-year clock or 59 and a half, whatever is later. So if you're 50 and you do a conversion, 59 and a half is later than 5 years. You got to wait till 59 and a half. After 59 and a half, you can get both your principal and your interest completely tax-free. If you are 58 and you do a Roth conversion, you got to wait 5 years, or the latter half, 59 and a half, whichever is longer. 5 years longer, you got to wait till you're 63 years old. So those are the 5-year rules when it comes to Roth conversions. Hopefully that helps. I'm curious. This is a big question. This is a question all of you guys have been asking. And now that I know what I know, I wish I would have handled this at the beginning, but that's okay. Why are REITs and preferred stock values going down in this market? I've seen this happening all year. I would think that these would be something most people want to invest in uncertain times like these. And I also want to throw in BDCs, business development companies, as well, too, as having been down dramatically over the last year or two. And we've gotten a lot of those questions. So I do want to address that. And there's a couple of things. First of all, fixed income is not necessarily market related. Now, some people, every single one of you who's become a client, has been told that your account value is going to fluctuate. And some people take that to mean that it's going to fluctuate straight up. Well, no, fluctuation goes both ways. But regardless of the fluctuation, your income is going to stay the same. But when it fluctuates down, we don't like it, right? Well, does it really matter? Other than for you, other than emotionally looking at the bottom line, which is, by the way, what you did for 40 years when you were in the accumulation phase of life, all you did was look at the bottom line. And whether your portfolio did good or bad depended on what that bottom line was. If the bottom line was higher this month, it was good. If it was lower, it was bad, because your goal is to accumulate for your portfolio. Your goal has switched. Your goal is not to accumulate. Your goal is to protect. Your goal is not putting money in. Your goal is to get money out. Your goal is to get income from the portfolio, and the bottom line doesn't matter. And there's only two categories of you. Either there's those of you that are getting income from your portfolio, and there are those of you that are reinvesting your interest and dividends. Now, when I say two categories, I mean, if you're a client of Providence Financial, those are the only two categories. If you're getting income from your portfolio, your income's going to stay the same regardless of the fluctuation. It doesn't affect your income. If you have $1 million account and it went down to $900,000 and you're getting $50,000 a year at $1 million, you're still getting $50,000 a year at $900,000. It doesn't affect you. We don't like to see the 900, but we're not focused on the 900. If you're selling shares like we talked about earlier and it drops to 900, that's a big deal. But if it drops to 900, you're living off the interest and dividends, it doesn't matter. Think about it this way. If you're eating the eggs, who cares what the value of the chickens are? It doesn't matter. If there's a poultry sickness out there or whatever, and all the chickens go down and your chickens are healthy and your chickens are fine and they go down, but you're still getting eggs, it doesn't matter what the value of the chickens are. But guess what? You get your statements and you look at the value of the chickens when that doesn't matter. So if you're getting income from your portfolio, it doesn't matter. You're still getting your income. The second thing, the second category of you are people who are reinvesting. And here's where it starts to get tricky. If the value of your portfolio goes down and you're reinvesting, it doesn't hurt you. It actually helps you. So if you are reinvesting, your interest in dividends because you don't need them, do you want us to reinvest them for you when the price of your investments has gone up and looks good on your portfolio and you have to pay a premium for those investments to reinvest in? Or when the price has gone down? Yeah, when the price has gone down. That is so counterintuitive that it blows a lot of your minds. We get some questions like, why is the portfolio down? Let me remind you, if it's down and you're reinvesting, it helps you. It doesn't hurt, but it's counterintuitive. It's not what you've been used to for 40 years, because 40 years we've been taught bad portfolio down, bad. That you're not in the accumulation phase of life. You're not invested for accumulation. You're invested for principal protection and consistent interest and dividends. And yet many of you still compare fixed income investments to the stock market. You're not invested in the stock market, or at least not the bulk of your money. Some of you have some 20, 30% in stocks, dividend paying value stocks. But the reality is that the bulk of your money is not in the stock market. You can't compare it to the stock market. Sometimes we get questions of, hey, my portfolio is even in or up by 5 or 6%, or maybe even down a little bit, but the market's up by 15%. How come? Because you're not taking the risk of the market. If you want to take the risk that we talked about earlier of a 50% crash, fine, let us know. We can help you with that. But that's not most of you. You're not taking the risk of the market. So you're not going to get the returns of the market, but you're also not going to get the crash of the market either. What you are going to get is consistent income. That's important to understand. So a lot of people are comparing the market to what we do when you're not in the market. That's like, comparing a pickup truck to a Porsche. They're two different things. The Porsche can't haul dirt, and the pickup truck can't do 150 miles an hour around a curve. They're two different vehicles. You're invested for principal conservation, protection, 5-6% a year, pretty consistent, so that when the market crashes, you're not going to crash with it. So we can't compare ourselves to the market. And that's a mistake that I often see a lot of people make. What's another mistake? Another mistake is putting fixed income on a market time frame. The market can act really quick. The market can drop or go up just like that. Fixed income doesn't do that. Fixed income is a slow and steady wins the race. And what affects fixed income more than anything is not the market. It's interest rates. Interest rates. And without getting in the weeds, the reason some of your portfolios have gone down, the reason preferreds have gone down, as is the question, preferreds and REITs, the reason they've gone down is because where have interest rates gone over the last year? Now, some of you are going to say they've gone down, Anthony. So our portfolio should have gone up. Au contraire, here's the problem. You're looking at the Fed funds rate. The Fed funds rate controls the short end of the curve. Your investments are more focused on the 10-year Treasury, which is the long end of the curve, which the Federal Reserve has no control over. And the 10-year Treasury has bounced around, but over the last year, it's gone up. It was at 5 at one point. It came down to 4.5 a couple years ago. It came down from 4.5 until last year. It came to about 4.5. It dropped down just under 4, and over the last year, it's crept up to back to 4.5. That's what's affecting your portfolios more than anything else is interest rates, not the stock market. So you don't want to compare it to the stock market. Interest rates up, fixed income portfolios down. But if you're living off of income, how much does that matter? And if you're reinvesting the income, does that actually hurt you or does it actually help you? I know it's counterintuitive, but that's the way that fixed income works. So that's the reason that the preferreds, the REITs, and the BDCs have gone down in value. Let me go a little further in the BDCs because they've come down a lot. I think some of the BDCs have come down 25 or 30% actually, whereas that's not the case for preferreds. It's not the case for REITs. So let's take a few minutes and talk about the BDCs. BDC is it stands for Business Development Company. They're a bank to businesses. So when you buy a BDC, what you're buying is you're buying potentially, you're buying the stock of a company that potentially has thousands of loans out there. So it's theoretically safer because there's loans. It's backed by contracts. It's backed by loans, but it could be a little more risky and they pay a higher dividend. I just looked at one today that I think was paying over 10%, not the BDC, but the whole portfolio of BDCs, I think was over 10%. And that's because the companies in there are not the Fortune 500 companies. These tend to be the medium-sized companies that, still might be large, still might be, $50 to $100 million a year, but they're not the Fortune 500. And there's some reasons why they are down more than most of you would think. Number one is they're not institutional investments. So you won't find them in mutual funds. You won't find them institutionalized. They're only owned by retail clients. And retail clients are subject to panic. Retail clients tend to panic more than certainly institutional clients. And there's been a lot of negativity in the news about private credit. You've probably heard some of it, seen some of it. A company called Blue Owl made the news. We've done some research on Blue Owl. There's nothing wrong with Blue Owl, but they don't when we're talking about digging in depth. But the reality is that they make it sound like this company's going out of business, and they put all private credit in the same category to make you think that if it's private credit, it's bad, it's going out of business. Everyone wants their money, they can't get them. No, it's noise. And when it comes to BDCs, there are certainly BDCs that are super hyper aggressive that you don't own. And there are BDCs that are much more secure, much safer. The BDCs we focus on, as far as I understand it, are focusing on senior positions loans, not secondary, not tertiary loans. You know, you could have a first mortgage on your home or a second mortgage or a third mortgage, right? And if your home gets foreclosed on, the guy in first place is good, but second and third's not. It's the same thing with business loans. But most of the BDCs that we focus on have primary loans in senior positions with established companies. Well, the reality is that the media takes all these private credit and puts them all into one blender, and everyone thinks that everything they say applies to everybody. No, there's truth to what they say, but it's applicable only to a segment. And when they talk about it, and then because these are retail owned, like, oh my gosh, I have BDCs, I'm going to panic, I'm going to go sell, and they sell the BDCs, and the BDCs drop. And in reality, there was nothing to panic about. But that's why a lot of your BDCs are down. So, but the income has stayed the same. As far as I know, no BDCs we have cut dividends. We've had this conversation with the analysts because of Blue Owl, because of some of the things. We're not worried. You shouldn't be worried at this point with the BDCs. So hopefully that answers that question. And we have gotten a lot of questions about BDCs. I'm actually surprised I didn't get any questions about BDCs here. So I kind of threw in this question. So we've got here, let me see. You know what? We can skip that one. That's a political question. I was going to hit it, but we don't have time. And that question is about an inherited IRA too. Most of you don't have an inherited IRA. So I'm going to leave it there. I think we've covered a lot. And I appreciate the feedback you've given me. And I'm so sorry for the interruptions. But I'm going to do two things right now. I'm going to make an offer to you. Lynn, you're funny. We have all night. Keep going. So thanks. So the reality is that I'm going to make you two offers at this point. The first offer is for those of you who are clients of ours. If you watch my YouTube videos, and this will come out on YouTube in a couple of days as well. We'll go cut out all the chatter and all the stuff you couldn't hear me. But if you watch my YouTube videos, then you know that a couple of weeks ago, I put out a video inviting you as a client of Providence Financial to our first ever referral event, which is going to be at Dodger Stadium. So it's at Dodger Stadium. We've rented out we bought 30 tickets in a box. And what that means for you is that if you have someone who you care enough about and you want to you want to refer them to us, you want to introduce them to us, you've got the peace of mind that because you've worked with us and you want that for them, then you're welcome to invite them to the Dodger game. Okay? And you come to the Dodger game. If you're married, you and your spouse. If they're married, them and their spouse. Come to the Dodger game, bring them. It's a Dodger game. We're not doing a seminar. We're not doing anything. I'm going to get a chance to shake their hand. If they're of retirement age or they're someone you think we could help, we're not looking for your grandkids or your kids. Not just, they got to be someone that you think that we might be able to help, someone that's got questions. But it's a really easy way to just introduce them to us. Some of my staff will be there. I'll be there. Shake hands. If they want to talk with us, great. If they don't want to talk with us, great. As long as you bring them, then they're your ticket in. So you can contact George Howard at the office. You guys have our office number, or you guys have an email, Twan's email, whoever's email. Contact George and let him know that you have someone, and he'll let you know what needs to happen to get you registered. You do have to RSVP. I think we're about half full, so we still have, that means we still have another 50% to go. I think we got room for another 14 or 15. So if you have someone that you like enough that you wouldn't want to go to Dodger game with them, and maybe you think we can help them, then that's what you're welcome to do that. Just talk to George. The second offer I have for you is for those of you who are friends and family, maybe not clients at Providence Financial. Because if you're a client of Providence Financial, you already are in touch with Jackie and Twan and Angel and our whole client service team. You're in touch with them. You know how to get your questions answered, and I would encourage you to answer any questions. So if you have questions because of anything I've talked about, talk to Twan. Get on Twan's calendar. If you want to get on my calendar, email me. So the offer I'm going to put up now is for those of you who are not clients. Maybe someone invited you here. Maybe you came because you've been hanging around us for a long time. However you got here, you're not a client of Providence, but you want to have a conversation with one of our advisors. I'm going to put an offer up that if you take us up on this offer, it's going to give you access to our calendar. What you're scheduling is a 30-minute introductory phone call with one of our advisors to answer any questions that you have, about what you learned or about your situation. And by the way, thank you. Someone said, when's the Dodger date? July 8th. So I regressed for a minute. July 8th is the Dodger date. It's a 7:10 game, and we'll all meet at the office. We'll take a shuttle down there so you don't have to deal with parking. And last time we took a shuttle somewhere with a client, it was fun. So if you are a friend or family and you're not a client of Providence and you've got questions maybe from some of what we've talked about, maybe you've been meaning to contact us and this kind of push you over the edge, I'm going to make an offer to you. I'm going to put it on the screen right now. It's going to open up our calendar. And if you take us up on that offer and you schedule a time, what you're scheduling is you're going to be scheduling a 30-minute call with one of our advisors to answer any questions that you have. That's it. Answer any questions that you have. So I'm going to put that on. So give me a second. Let me put it. It's there. It's there. Okay. So you should be able to see it. Which means that if you click on offers, you're going to see something pop up. And you should be able to see where it says offers. Click on that offer. It will take you right to our calendar. Schedule a time, 30-minute call with one of our licensed fiduciary advisors. It's your 30 minutes. You can talk about whatever you want. If you just have a simple question about an RMD, an inherited IRA, Roth conversion, whatever it is, you can ask the question. If you want a deeper analysis, they'll walk you through that process as well too. And we can give you a deeper analysis. I hope this has been helpful and certainly have enjoyed talking with you. We will put it out in a couple of days. But meanwhile, I really, really thank you for attending. And I'll leave this open for a few minutes. So for those of you that want to take us up on that offer and schedule a time, you can do that. I'll leave it open for the next 15 minutes. Thank you all. God bless.